Warren Buffett, who is famous for holding great companies forever, just sold the last share of BYD, China's EV champion. Most headlines call it simple profit-taking, but that's only half the story. His exit marks a turning point for China's electric vehicle boom, where slowing growth and hidden financial stress collide. So let's unpack the story and explore how Buffett's $230 million bet turned into billions. What global and Chinese analysts are saying about BYD's future, and why structural habits inside China's EV market, supplier IOUs, disguised sales, and relentless price wars are far more than background noise. Back in 2008, Berkshire's Mid-American unit bought roughly 225 million shares worth around $230 million. By late 2021, that stake was worth over $9 billion, giving Buffett a return of more than 35x at peak valuation. At the time of investment, BYD was delivering fewer than 200,000 vehicles per year. Fast forward to 2023, it sold 3 million cars, overtaking Tesla in total EV and plug-in hybrid sales. By mid-2024, its market share in China's new energy vehicle segment exceeded 35%. Buffett's presence created what became known as the Buffett Premium. Headlines regularly attached his name to BYD's stock, which boosted investor confidence and arguably reduced BYD's cost of capital. For years, international funds cited Buffett's endorsement as a reason to allocate into BYD, despite the risks of China exposure. That credibility acted like a protective shield, and that's exactly why his complete exit now lands like a thunderclap. Berkshire began trimming in mid-2022, selling in increments that reduced its stake below the 5% disclosure threshold by 2024. The March 2025 filing shows the position at zero, down from $450 million, reported just months earlier. BYD's stock reacted instantly, falling around 3 to 4% in a single session, wiping out roughly $10 billion in market value and have underperformed the Hang Seng Index by roughly 18 percentage points year to date. Analysts see more than profit-taking. Vincent Sun from the Morningstar projects BYD will ship 4.8 million vehicles in 2025. Solid growth, but short of the company's 5.5 million target. Independent analyst Lei Xing says BYD is leaving its high growth phase, where sales were compounding at over 60% annually between 2020 and 2023, and entering a slower, more competitive era. Research firm A Invest notes, profit margins fell by nearly 30% year-on-year in 2024, as BYD slashed prices by up to 34% on popular models like the Chin Plus and Dolphin to defend market share. Chinese commentary echoes the concern. Nigh 500 cites analysts warning of intensified competition and profitability pressure, while Sina Finance frames the sale as a potential industry turning point. BYD's own spokesperson stayed neutral, stating, "Investment involves buying and selling, different narratives, but they all converge on one point. BYD is under pressure from slowing growth, tighter margins, and a far harsher competitive landscape. And those stresses aren't abstract, they're structural." Take supplier payments. Many Chinese automakers, including some of BYD's peers, have been reported to stretch payables well beyond 100 days, effectively using suppliers as banks. In June 2025, 17 automakers signed a government-backed pledge to shorten cycles to 60 days, a signal of just how strained the supply chain had become. Next, hidden liabilities. BYD's reported leverage looks moderate, but when you include trade payables and supplier IOUs, its short-term obligations swell dramatically. Industry data shows that more than one-third of Chinese automakers ended 2024 with current liabilities greater than current assets, a classic liquidity red flag. Then there's the issue of zero-mileage sales. Investigations in mid-2025 revealed brands like Zeekr and Neta ensuring cars are sold before delivering to customers, creating a pipeline of tens of thousands of units that technically count as used but have never been driven. This practice inflates delivery figures, helps hit subsidy thresholds, and masks weekend demand. These behaviors are all tied directly to the margin compression analysts cite. We recently did a deep dive into those structural risks within China's EV market. Link in the top right card and in this video's description. when prices are cut by 20–30% and net margins fall from 5–6% to barely 3%, delayed payments and disguised sales aren't side notes, they're survival tactics. Buffett's exit, whether or not he mentioned these mechanics, is consistent with a market where structural shortcuts have become systemic risks. And that's why his timing matters far beyond BYD itself. Buffett's departure removes a quiet confidence flaw. For 17 years, global investors could point to Berkshire's stake as validation that BYD was worth holding through cycles. That backstop is now gone. The implications go beyond BYD. Foreign capital is already cautious on Chinese equities. A high-profile exit like this reinforces the perception of higher risk premiums. Global supply chains, from lithium to semiconductors, are watching. If the strongest Chinese EV player is relying on deferred payments and razor-thin margins, what does that imply for smaller rivals? Domestically, China's new energy vehicles market may be heading into a consolidation phase, where only the best capitalized, most disciplined firms survive. It's a reminder that rapid growth can hide fragile economics, and that patient capital, like Buffett's, ultimately exits when predictability fades. Buffett's BYD exit isn't just a 20-bagger payday, it's a signal. Growth is slowing, margins are thinning, and China's EV market is getting harder to trust. Is this classic Buffett discipline, or a warning for anyone holding BYD or any China EV stocks? Drop your take below and catch our full deep dive on the hidden structural risks linked right here.